As we watch the market clock today, Nokia stock is currently locked at a closing price of $16.73 per share on the New York Stock Exchange, recorded at the final bell on June 3, 2026 at 4 p.m. Eastern Time. Looking across the broader landscape, this sits against a backdrop of intense volatility, where heavyweights like Nvidia stock, Apple stock, and Tesla stock continuously dominate daily trading headlines. Yet, if you peel back the surface layers of the tape, the real surprise isn't happening in high-flying Silicon Valley boardrooms, but rather within a legacy European infrastructure giant that most retail accounts forgot existed. While thousands of individual brokerage accounts have been hyper-focused on standard tech names, this legacy asset has quietly put together an astonishing 159% run over the past 6 months, culminating in massive trading volumes that completely caught Wall Street off guard. The expectation deeply embedded across mainstream retail trading platforms, from the casual user scrolling through the Robinhood app to long-term index investors holding diversified baskets, is that this company is a dead tech relic. The collective memory of the market views it as a slow-moving, low-margin telecommunications hardware provider, tied to the cyclical capital expenditure budgets of global mobile carriers. Reality, however, has delivered a massive shock to this thesis. Under the radar of general financial media, the firm has secured a massive partnership with major hardware providers, pulled in over €1 billion in backlogged infrastructure orders, and experienced a 49% surge in cloud-based business during the opening months of the year. This underlying friction between a legacy perception and a high-tech reality is exactly why institutional money is suddenly flooding into the asset, triggering aggressive price target upgrades from major investment banks and causing massive volume spikes on major investing sites. If you open up your favorite mobile application or log into the Interactive Brokers platform to study the recent tape, you can see this tension playing out in real time. Just days ago, the equity surged past its prior limits to set a fresh multi-year high, backed by a staggering intraday volume of over 146 million shares traded in a single session. This is not the behavior of a sleepy income stock. This is intense momentum driven by institutional reindexing. Professional managers allocating capital through Schwab Intelligent Portfolios and Fidelity Wealth Management platforms are being forced to aggressively adjust their models because the firm's forward valuation multiples have expanded from 17 times to nearly 36 times earnings in less than 2 quarters. When you see that kind of massive multiple expansion, it means the market is fundamentally changing its mind about what the business actually is, shifting it out of the legacy telecom bucket and into the premium infrastructure tier. This rapid re-rating has turned the stock into a battlefield for various retail trading styles. On one hand, active day traders utilizing the SoFi trading platform are chasing the daily breakouts, capitalizing on the high liquidity and clear upward stair-step patterns on the 5-minute charts. On the other hand, long-term wealth allocators reviewing data on Fidelity investments look at the sudden vertical move with a degree of healthy skepticism, wondering if the underlying cash flows can truly sustain this sudden premium. The primary catalyst for this recent price action stems directly from a structural shift in how data centers are constructed. As tech giants build out massive clusters containing tens of thousands of high-powered processing chips, the physical cables and switches that connect these machines have become the ultimate operational bottleneck. This firm's high-speed optical transport division, which specializes in moving vast amounts of data over fiber networks with minimal latency, is suddenly seeing a historic influx of purchase orders from the largest cloud hyperscalers. Let's pause here for a moment because I want to hear your perspective on this massive structural shift. Comment below how many shares of Nokia stock you currently hold in your portfolio, or if you prefer trading other infrastructure names instead. When you dig into the corporate architecture to understand what the underlying business model actually looks like, you find a company completely divided into 2 distinct worlds. For the past decade, the organization has generated the vast majority of its revenues from its mobile networks division, selling cellular base stations, antennas, and radio access networks to global telecom providers. This legacy segment still accounts for more than half of total revenue, but it has turned into a major drag on corporate growth due to flat capital spending in North America and fierce international competition. The second, smaller half of the business is network infrastructure, which encompasses IP routing, optical networks, and advanced software solutions. It is this specific segment that is driving the entire equity story right now. By acquiring specialized optical firms and setting up specialized co-development laboratories in Silicon Valley alongside players like Advanced Micro Devices and Supermicro, the company has positioned its hardware at the literal core of modern data center construction. Looking back at past performance to see how we arrived at this point, the historical data highlights just how severe the long-term neglect was. After losing massive market share in the mobile phone business decades ago, the firm pivoted entirely to back-end networking hardware, but spent years stuck in a low-growth, low-margin environment. Long-term investors executing self-investing strategies through online banking apps or holding specialized Fidelity ETFs viewed the asset as a permanent value trap. The financial turnaround began to crystallize late last year when a major visual computing pioneer completed a massive 9-figure investment to secure a core equity stake in the firm. This strategic alliance was designed to build out inline network acceleration frameworks, directly integrating data routing systems with graphics processors to handle intense computational workloads.
When the company reported its first quarter financial results a few weeks back, the structural shift became undeniable, showing a 54% jump in comparable operating profit that completely blew past the consensus estimates compiled by sell-side analysts. As we look toward the future horizon, the central question for anyone doing online investing or managing an individual brokerage account is whether this massive expectation versus reality gap has already been fully priced into the market. There are two clear scenarios that could play out over the next 12 months. In the bullish scenario, the massive backlog of data center orders continues to accelerate, completely offsetting the structural weakness in the legacy mobile carrier business and justifying the newly expanded valuation multiple. In the bearish scenario, the legacy telecom division remains a permanent anchor on corporate margins, and the sudden boom in optical infrastructure orders faces a cyclical cooling period as hyperscalers slow down their initial building phase. Furthermore, the consensus price targets across 23 major sell-side research firms still sit significantly lower than the current market price, suggesting that mainstream analysts are struggling to reconcile this rapid run with traditional fundamental models. To wrap things up and look at the core of this entire situation, this asset has completely rewritten its market narrative by defying its historical reputation as a slow-moving utility supplier. The expectation was a faded tech giant stuck in a stagnant hardware cycle. The reality is a vital cog in the physical build-out of global data center infrastructure. Whether you execute your trades through the simplicity of the Robinhood app, build automated strategies via interactive brokers trading, or let an automated algorithm manage your risk through an intelligent portfolio, tracking these sharp structural inflections is exactly how you identify real value before the rest of the street catches on. The massive multiple expansion we have witnessed over the last 6 months proves that market perceptions can shift incredibly fast when real institutional money starts chasing a finite supply of hardware assets. Keep a very close eye on the upcoming quarterly margin data, because that is where the battle between legacy telecom drag and high-speed infrastructure growth will ultimately be won or lost.